Hello guys, today I'm talking about what happens if my ETF closes, delists, merges, shuts down, liquidates, any other means that you're not going to own this ETF anymore. It was important for me to look this up for myself because half my money's in ETFs, at least half my money's in ETFs, and I just want to know what happens when they close down. And it's just a question that I couldn't find answered on YouTube very well. A lot of people are jumbled around about it, so I did my own little research thanks to actually The Balance, which is another news station. I'll put the article I used in the link below. It's just something that I wanted to ask and something that nobody had an answer to. And I kind of, if I ever have a question that I look up and I see that people haven't really been answering on YouTube, I think I'll just start with making videos on those. They're just strictly educational, just strictly, there's no opinions here. This is just what happens when shit hits the fan and your ETF's getting delisted or so we're gonna start with why this could happen. Why could your ETF be delisted? Mostly it's because of low interest from investors. So if you have an ETF that's very specific, let's say your ETF is just a gold mining stocks, no silver, no nothing, just gold mining stocks, and that's a very, very specific thing. People might not have as much interest in that ETF, which means that you're going to have trouble finding the money to hold that ETF, and also the sponsor is not going to be making enough money, which means that the person getting the ETF with the MER are the people who are hosting the ETF and collecting the MER aren't seeing the benefits they should when they could otherwise be hosting a different ETF. So that's important because I wouldn't say it's very common for ETFs to be delisted, but common enough actually. But I couldn't find any real solid information from Vanguard or BlackRock myself that said exactly how many ETFs were delisted per year. As far as I'm concerned, about 200 got delisted in 2020, so like 2 years ago, old data. I couldn't find anything strictly recent, so it happens. Not a lot, but enough. And when your ETF does get delisted and liquidated, you get a 30 to 60 day notice, and you have a few steps from here. It's not just you get your notice, sell your shares as quick as you can. With this notice, they tell you what they're going to be buying the shares at the end of the notice for. So let's say that the market values your ETF at $25 and the sponsor said, I will liquidate it at $27. But then the market value, because everyone's selling, is going down to $24. You might as well hold it until the end of the maturity date of the delisting. So yeah, you can sell your shares at market value. If the market value is above the notice set value, that makes sense. But if it's below, then you can hold it and wait until your sponsor will sell you the shares at this agreed price. That agreed price is not, they can't just say, no, we're going to sell it to you for $2 or we're going to give you $2 a share. They can't just drop it substantially like that. That's a process that they go through with the SEC for the investors. So you are a little bit more protected there. I've actually been through a merging with one of my industrial REITs, and I didn't even know what was happening. I ended up coming out with more money than the agreed price or the market value price was. So it was good that I held it, but it's just good to know these things because I didn't even know what was happening. I got a big booklet in the mail and I got it late. So it's good to know how to react when you get stuff like this. So after that, unlikely they move it to the OTC market. That's not a very common option. I think I've seen like one of them get moved to the OTC from what I could find. So it's very uncommon. You experience high volatility. They're very illiquid because not a lot of people are buying them. That's got very low traffic. So if you see that it's getting moved to the OTC market, that's a bit of a step down. So I would be a little more worried there, or at least if I seen that, knowing what I know, I personally would be worried to see my ETF go to the OTC market. That's not to say that it doesn't have its advantages. High volatility comes with extra highs and extra lows. So, but personally, I would steer away from that option if I could. I obviously don't make the decisions in it, but personally, I don't like the OTC market. ETF merged with another ETF. So you get the transferred value at the agreed price. So let's say your ETF is $25 and it's merging with a bigger ETF that's $50. You would get one of the new ETF for every 2 shares that you own. Or an agreed set price. So they might give you a premium, they might not. That is, again, that's something that you can vote for when you own an ETF with the sponsor, if they let you. But that's not always the case. So there are some other challenges. If it could be expensive for them to sit there and decide if they're going to merge with a different ETF, and getting everyone to vote on these things can be timely. It costs a lot of money for the sponsor, so I don't see that as a great option in most cases, but that is an option that they have and they can do. And lastly, how can we avoid stuff like this? How can we not have an ETF that is going to go through some pretty bad hardships? Well, you can find out the buyout value. You can look at ratings. Find out if your ETF is held by a sponsor that is reputable. Essentially, this boils down to doing your due diligence on buying something. You should know what you buy. If you are buying an ETF for, again, let's say a gold ETF, a gold share ETF that is held by a sponsor who no one's ever heard of before, and the ETF hasn't been around long, and there are some little red flags all over the place, I would be wary. If you own a Vanguard or BlackRock ETF that's been around for 50, let's say VOO and SPY, those ETFs have been around a long time. Would you say that they are going to be around for the next 25 years as opposed to an ETF that came out 2 weeks ago that no one's ever heard of from some company who is just, no one's heard of these people? You run that risk of the unknown. You run the risk of having it turn out to be a great ETF, but you run the risk of the unknown. So that's the volatility, that's the due diligence. What do you trust? And if there's a downturn, what can you confidently hold through hardship? Anyways, guys, that's basically it for me. Just wanted to know what happened to your ETF, and apparently the market is set to go down a bit more. I took a little hit on the Friday, so just like maybe some of you at this time. Yeah, looking forward to it. Have a good one, guys. Peace.